We are witnessing something extraordinary in the precious metals markets. Gold and silver are not just rising, they are breaking through resistance levels that have held for years, propelled by a convergence of market signals that veteran traders recognize as once-in-a-decade opportunities. But before you rush to make any decisions, understand this. What we're seeing today is not random market noise. This is the culmination of macroeconomic forces that have been building for years, finally reaching a tipping point that demands your attention and, more importantly, your understanding. In the next 25 minutes, we will dissect exactly what is happening in these markets, why it matters for your financial future, and most critically, how to navigate this historic moment with the discipline and clarity that separate successful investors from those who get swept away by market euphoria. This is not about getting rich quick. This is about recognizing a fundamental shift in the global financial landscape and positioning yourself accordingly. Let's begin with what we're observing. Gold has surged past psychological resistance levels that analysts have watched for months. Silver, historically more volatile than its golden counterpart, is experiencing even more dramatic moves, with industrial demand combining with investment demand to create a perfect storm of upward pressure. But these price movements are symptoms, not causes. To understand what's really happening, we need to examine the underlying market signals that are driving this historic moment. The first signal is monetary policy exhaustion. Central banks around the world have painted themselves into a corner. Years of ultra-low interest rates and quantitative easing have created asset bubbles and distorted market pricing mechanisms. Now, as inflation pressures mount and currency debasement concerns grow, investors are seeking assets that cannot be printed into existence. The second signal is geopolitical instability. Regional conflicts, trade tensions, and currency wars have accelerated the search for safe haven assets. When trust in institutions wavers, precious metals historically become the refuge of choice for sophisticated money. The third signal is technical momentum. Years of sideways price action in precious metals have created massive coiled energy. When these consolidation patterns finally break, the resulting moves can be swift and substantial. Every fiat currency system in history has eventually faced the same challenge: the temptation to solve problems by creating more money. We are currently witnessing this phenomenon on a global scale. When central banks expand money supply faster than economic growth, the excess liquidity has to go somewhere. Initially, it inflates financial assets, stocks, bonds, real estate. But eventually, this liquidity begins to question the underlying value of the currency itself. Gold and silver serve as monetary thermometers. When their prices rise persistently, they are signaling that the market is losing confidence in paper currency's ability to maintain purchasing power over time. Think of it this way. If you knew that the purchasing power of your savings would decline by 3 to 5% annually, wouldn't you seek assets that could preserve or grow your wealth? This is exactly what institutional investors, sovereign wealth funds, and central banks themselves are doing. The 1970s offer valuable insights into our current situation. During that decade, similar macroeconomic conditions, high inflation, currency instability, geopolitical tensions, drove gold from $35 to over $800 per ounce. But history doesn't repeat, it rhymes. Today's drivers are different, but equally compelling. We have unprecedented global debt levels, demographic challenges in developed nations, and technology disrupting traditional economic models. The key lesson from previous precious metals bull markets is that they don't move in straight lines. They experience corrections that shake out weak hands while rewarding those who understand the underlying fundamentals. Silver's situation is particularly compelling because it faces supply-demand dynamics that gold does not. While gold is primarily a monetary metal, silver is both a monetary asset and an industrial commodity. The green energy revolution requires massive amounts of silver for solar panels, electric vehicles, and energy storage systems. Simultaneously, silver's monetary properties are attracting investment demand as investors seek alternatives to traditional assets. This dual demand creates a scenario where industrial users compete with investors for limited supply. When investment demand accelerates, as we're seeing now, it can create acute shortages that drive dramatic price movements. Markets are driven by two primary emotions: fear and greed. Right now, we're seeing both simultaneously. Fear is driving investors away from assets they perceive as overvalued or risky. Stock markets at historic highs, bond markets facing interest rate uncertainty, and real estate markets stretched by years of easy money have created anxiety about traditional portfolio allocations. Greed is drawing investors toward assets that appear to offer protection and growth potential. Precious metals, after years of sideways movement, suddenly look attractive to momentum-seeking capital. But successful investing requires us to move beyond emotional reactions and focus on fundamental analysis. Central banks find themselves in an impossible position. They need to maintain currency stability while supporting economic growth and managing unprecedented debt levels. This trilemma, managing currency, growth, and debt simultaneously, has no easy solutions. Every policy choice involves trade-offs that create opportunities in other markets. When central banks choose currency stability, they risk economic slowdown. When they choose growth, they risk currency debasement. When they choose debt management, they risk both growth and currency stability. Precious metals benefit in all three scenarios because they represent an alternative to the central banking system entirely. Something fundamental has changed in how institutions view precious metals. What was once considered a relic of the past is now being recognized as a necessary portfolio component for the future. Major pension funds, insurance companies, and sovereign wealth funds are increasing their precious metals allocations. This institutional adoption provides a foundation of demand that didn't exist in previous bull markets. When institutional money moves, it moves in size and with conviction. These are not day traders looking for quick profits. These are fiduciaries responsible for preserving wealth across decades. The infrastructure for institutional precious metals investment has also evolved. Exchange-traded funds, futures markets, and specialized investment vehicles have made it easier for large institutions to gain exposure to precious metals markets. This institutional participation changes the character of precious metals bull markets. Instead of purely speculative bubbles, we're seeing measured strategic allocation decisions based on portfolio theory and risk management principles. If you currently own precious metals, this historic moment requires careful consideration of your strategy and objectives. First, avoid the temptation to view recent gains as validation that you should increase risk. Strong performance often leads to overconfidence, which can result in poor decision-making. Instead, use this opportunity to review your overall portfolio allocation. Have precious metals grown from 5% of your portfolio to 15% due to price appreciation? If so, you may want to consider rebalancing to maintain your target allocation. Remember that portfolio management is about maintaining balance, not maximizing exposure to your best performing assets. Consider implementing a systematic approach to profit taking rather than trying to time the market perfectly. This might involve selling small percentages of your holdings at predetermined price levels or time intervals. The goal is not to capture every dollar of appreciation, but to ensure that you realize some profits while maintaining core exposure to the long-term trend. Think of profit taking as insurance against your own potential mistakes, rather than a prediction about market direction. As precious metals values increase, storage and security become more critical. Review your current storage arrangements and ensure they remain appropriate for higher values. Consider diversifying storage locations and methods. Physical possession provides maximum control but involves security risks. Professional storage services offer security but involve counterparty risk. The optimal solution often involves a combination of storage methods that balance convenience, security, and cost considerations. Rising precious metals. Prices create tax implications that require advanced planning. Understand the tax treatment of your specific investments and consider strategies to minimize tax impacts. This might involve holding periods, loss harvesting in other investments, or retirement account allocation strategies. Consult with tax professionals who understand precious metals investments. If you're considering precious metals investment for the first time, this historic moment offers both opportunity and risk. Begin with education, not investment. Understand the different ways to invest in precious metals, physical metals, exchange-traded funds, mining stocks, and futures contracts. Each have different risk and return characteristics. Physical metals provide direct exposure but involve storage and insurance costs. ETFs offer convenience but involve management fees and counterparty risk. Mining stocks provide leverage but add company-specific risks. Start with small positions that allow you to learn without risking significant capital. The goal initially should be understanding how precious metals behave in different market conditions. Most financial advisors suggest precious metals allocations between 5 and 10% of total portfolio value. This provides a meaningful exposure without creating concentration risk. Consider your age, risk tolerance, and investment timeline when determining appropriate allocation. Younger investors with longer time horizons might accept higher volatility for potential growth. Older investors might prioritize wealth preservation. Remember that precious metals are portfolio insurance, not growth engines. Treat them as protection against currency debasement and financial system instability rather than vehicles for aggressive wealth building. Avoid the temptation to invest lump sums during periods of strong price appreciation. Instead, consider dollar-cost averaging over several months to reduce timing risk. This approach ensures that you don't invest all your capital at potential market peaks, while still gaining exposure to the underlying trend. Set predetermined investment amounts and schedules, then execute regardless of short-term price movements. This removes emotional decision-making from the investment process. Research dealers, storage facilities, and investment vehicles thoroughly before committing capital. The precious metals industry includes both reputable professionals and questionable operators. Verify credentials, read customer reviews, and understand fee structures completely. Be particularly cautious of high-pressure sales tactics or promises of guaranteed returns. Remember that legitimate precious metals investments involve risks and costs. Anyone promising risk-free profits or urging immediate action should be viewed skeptically. The biggest threat to precious metals investors is their own emotions. Fear of missing out drives people to buy at peaks. Fear of losses drives them to sell at bottoms. Successful precious metals investing requires the emotional discipline to ignore daily price fluctuations and focus on long-term fundamentals. Create written investment plans that specify your objectives, time horizon, and exit criteria. When emotions run high, refer to your written plan rather than making impulsive decisions. Precious metals can be volatile investments. Using excessive leverage can lead to devastating losses. Futures contracts, margin accounts, and leveraged ETFs can amplify both gains and losses. Avoid borrowing money to invest in precious metals. Use only capital that you can afford to lose without affecting your basic financial security. Remember that preservation of capital is more important than maximization of returns, especially for money you cannot afford to lose. No one can consistently predict short-term price movements in precious metals markets. Attempting to time entries and exits perfectly usually results in buying high and selling low. Instead of trying to time the market, focus on systematic approaches that reduce timing risk. Dollar cost averaging, rebalancing, and predetermined profit-taking rules remove emotional decision-making from the investment process. Accept that you will not buy at the bottom or sell at the top. Successful investing is about capturing most of a trend, not perfecting every transaction. The precious metals industry includes legitimate businesses and questionable operators. Failing to research dealers, storage providers, and investment vehicles can result in fraud or excessive fees. Verify that dealers are properly licensed and insured. Understand storage arrangements and insurance coverage. Read all documentation carefully before committing funds. Be particularly cautious of unsolicited sales calls, high-pressure tactics, or promises that seem too good to be true. Legitimate precious metals investing involves risks and costs that should be clearly disclosed. Putting too much of your wealth in precious metals creates concentration risk that can be as dangerous as having no precious metals exposure at all. Maintain diversified portfolios that include multiple asset classes. Precious metals should complement, not replace, traditional investments like stocks and bonds. Remember that even the best investment thesis can be wrong. Diversification protects against both the risks you anticipate and the ones you don't see coming. Precious metals investing involves various costs that can erode returns over time. Physical metals involve storage, insurance, and transaction costs. ETFs charge management fees. Mining stocks involve brokerage commissions. Understand all costs associated with your chosen investment approach and factor them into your expected returns. High costs can turn winning investments into losing ones over time. Compare costs across different investment vehicles and choose approaches that minimize expenses while meeting your objectives. Understanding precious metals requires understanding their relationship to other asset classes and macroeconomic conditions. Precious metals traditionally move inversely to the US dollar, though this relationship can break down during periods of global stress when both dollars and precious metals are sought as safe havens. Monitor currency trends and central bank policies that might affect dollar strength. A weakening dollar environment generally supports precious metals prices, while dollar strength can create headwinds. Remember that precious metals are global assets traded in multiple currencies. What matters is not just dollar strength, but global currency relationships and confidence in fiat money systems. Rising interest rates traditionally create headwinds for precious metals because they increase the opportunity cost of holding non-yielding assets. However, when interest rates fail to keep pace with inflation, creating negative real interest rates, precious metals become more attractive as inflation hedges. Current market conditions suggest that central banks are behind the inflation curve, creating an environment where real interest rates remain negative despite nominal rate increases. Precious metals are often called inflation hedges, but their relationship to inflation is more complex than many realize. They tend to perform well during periods of unexpected inflation or when inflation is accompanied by currency debasement concerns. However, they can struggle during periods when central banks successfully combat inflation through aggressive monetary tightening. Current inflation dynamics suggest that central banks face challenges controlling price increases without triggering economic recessions, creating supportive conditions for precious metals. Successful precious metals investing requires systematic risk management that goes beyond simple buy and hold strategies. Never risk more than you can afford to lose on any single investment theme, including precious metals. Even the most compelling investment thesis can be wrong or take longer to play out than expected. Use position sizing rules that limit precious metals to percentages of your portfolio that won't devastate your wealth if the investment thesis fails. Consider your overall financial situation, including income stability, emergency fund adequacy, and other investment holdings when determining appropriate position sizes. Don't concentrate all precious metals investments in a single metal or investment vehicle. Gold and silver have different supply-demand dynamics and may perform differently in various market environments. Consider combinations of physical metals, ETFs, and mining stocks that provide exposure to different aspects of the precious metals complex. Remember that diversification within precious metals doesn't eliminate precious metals risk, but can reduce specific risks related to individual metals or investment vehicles. Develop clear criteria for reducing or eliminating precious metals positions before you need them. Emotional decision-making during stressful market periods rarely produces optimal outcomes. This might involve price targets, time-based reviews, or fundamental changes to the investment thesis that originally justified the investment. Write down your exit criteria and review them periodically to ensure they remain relevant to current market conditions and your personal financial situation. Precious metals. Investing tests psychological discipline in ways that other investments may not. Precious metals can experience significant short-term volatility that tests investors' resolve. Prepare mentally for periods when your investments decline in value despite sound fundamental reasons for ownership. Focus on the reasons you invested rather than daily price movements. Keep written records of your investment thesis to review during stressful periods. Remember that volatility is the price of potentially higher returns. Assets with lower volatility generally offer lower long-term returns. Successful investors seek information that challenges their beliefs, rather than only consuming sources that confirm their existing views. Read analysis from precious metals skeptics as well as advocates. Understand the strongest arguments against your investment thesis, and monitor whether market conditions are changing in ways that might invalidate your reasoning. Intellectual honesty about your investment's weaknesses makes you a better investor than blind faith in any particular asset class. Precious metals investing can be lonely, especially when these assets are out of favor with mainstream financial media and popular opinion. Prepare for periods when your investments underperform popular alternatives and friends question your investment decisions. Remember that contrarian investing requires the psychological strength to maintain convictions when they are unpopular, while remaining open to changing your mind when facts change. The precious metals markets are evolving with technology in ways that create both opportunities and risks for investors. Cryptocurrency markets have created new ways to gain precious metals exposure through digital tokens backed by physical metals. These innovations offer convenience but add technological and regulatory risks.